Welcome back, everyone. Today, we're about to dive into one of the most powerful yet misunderstood tools in finance: compounding. Imagine you've just won a lottery and you're given two options to claim your prize. Option 1 is to take a cool $1 million in cash immediately, no strings attached. Option 2 is different. You start with just $1 on the first day, which doubles every day for 31 days. At first glance, most people would leap at the $1 million option. After all, who wouldn't want instant access to a massive lump sum? But if you pause to think about option 2, the potential payoff is staggering. That single dollar, doubling daily, would turn into over $1 billion by day 31. It's a scenario that illustrates the power of compounding in action. And it's no surprise that Albert Einstein famously called compounding the eighth wonder of the world. Compounding might seem simple, but its effects are profound. This isn't just about saving a little each month, it's about creating exponential growth that builds over time. And today, we'll break down what compounding really is, why most people miss out on it, and how you can use it to build wealth steadily and reliably. So, whether you're new to investing or looking for ways to maximize your returns, stick around. Wake up to the power of compounding money, and you'll see how patience, consistency, and a little bit of strategy can transform your financial future. Let's get started on understanding this incredible force. Coming up, we'll explore the fundamentals of compounding and reveal why small, consistent actions can lead to life-changing financial outcomes. Compounding is often compared to a snowball rolling down a hill. At first, the snowball is small and the growth isn't dramatic. But as it picks up speed and mass, its growth accelerates, creating a massive snowball by the time it reaches the bottom. Compounding works in much the same way. But instead of a snowball, you're dealing with money, and instead of a hill, you're using time. In basic terms, compounding is earning interest on both your original investment and any interest that has already been added to it. Let's break this down with a simple example. Suppose you invest $10,000 at a 10% annual return. In the first year, you'd make $1,000 in interest, bringing your balance to $11,000. But here's where the magic happens. In year 2, your 10% return doesn't just apply to your initial $10,000. It applies to the entire $11,000. Now, you're making $1,100 in interest instead of $1,000. As you let time do its work, this growth multiplies. After 10 years, you would have around $25,937 without adding any extra money. That's the power of compounding, interest on interest, allowing small amounts to snowball into substantial sums. It's why compounding is often called money-making money. The secret to maximizing compounding lies in patience and consistency. The more time you give your money to grow, the greater the rewards. Wake up to the power of compounding money and realize that even modest investments can yield incredible results when left to compound over time. Next, we'll uncover why so many people miss out on this powerful concept and how you can avoid common pitfalls that prevent true wealth building. If compounding is so powerful, why don't more people take advantage of it? The answer lies in our human nature, especially our desire for instant gratification. We live in a world of immediate rewards. Fast food, one-day shipping, instant downloads. Waiting has become a lost art. This impatience carries over into our financial lives as well. When given the choice, most people would choose the immediate reward, like the $1 million option, because it's tangible and available now. Compounding, on the other hand, starts slow. Imagine investing $100 at a 10% return. In the first year, it grows to just $110. Not exactly exciting, right? The real growth, however, happens over time. In 20 years, that $100 would grow to $672, and if you leave it for 40 years, it becomes $4,525. But there's another reason people miss out on compounding. They don't understand how it works. In finance, the phrase "time in the market beats timing." The market is popular for a reason. Compounding rewards those who let their money work for them over time. Yet people get discouraged by small early returns, not realizing that the real magic happens later. To truly wake up to the power of compounding money, you need patience and a long-term view. Forget quick gains and focus on steady growth. The rewards may be delayed, but the impact is transformative. The lesson? Start investing early, even if it's just a small amount. Your future self will thank you. I hope you found this video helpful. If you're eager for more content like this, drop a comment below saying, "I'll be the first wealthy person in my family." That way, I'll know exactly what types of videos you enjoy most. Next, we'll explore the dark side of compounding, when it works against you, and how to avoid these costly traps. Compounding is powerful, but it's a double-edged sword. When it's working for you, it's a wealth-building machine. But when it works against you, it can drain your finances faster than you might expect. Enter the world of high-interest debt, especially credit cards. Credit card companies charge between 18 and 25% interest annually on unpaid balances. Just like with investments, this interest compounds, but in reverse. Imagine carrying a $5,000 balance on a credit card with a 20% interest rate. If you only make minimum payments, you're essentially allowing that interest to compound against you. Each month, unpaid interest is added to your balance, increasing what you owe and therefore the interest charged. Left unchecked, that debt can spiral out of control, growing faster than you can pay it off. Credit card companies thrive because most people don't pay off their full balance. Instead, they only pay the minimum amount due, allowing the compounding interest to turn a small balance into a significant financial burden. So, how do credit card companies fund those enticing rewards for people who pay on time? By charging high interest rates to everyone else. To wake up to the power of compounding money, avoid negative compounding like the plague. Pay off high-interest debt as quickly as possible and never let compounding work against you. Debt with compounding interest is a trap that keeps you financially stagnant, or worse, pulls you further into debt. Stick around because we're about to explore strategies that help you turn compounding into a wealth-building force for good. Let's get into the exciting part: how to make compounding work in your favor. The strategy is simple but requires discipline. Start early, invest regularly, and give it time. This formula has created more wealth than any get-rich-quick scheme ever could. Imagine you start investing $500 per month at an 8% annual return. Over 30 years, this modest contribution would grow to about $750,000 thanks to compounding. That's right. Your steady monthly deposits allow the compounding effect to work its magic. But here's the best part. If you start increasing your investment as your income grows, you could reach $1 million or more by retirement. Take Warren Buffett as a prime example. Most of his wealth was built after age 50, not because he was taking big risks, but because he let compounding work over time. Buffett has always emphasized consistency and long-term thinking over short-term gains, proving that the compounding principle works when you stick to it. The takeaway? Start now, even if it's small. Let compounding turn those small steps into a powerful force. This is how you wake up to the power of compounding money and create wealth without needing a huge starting amount or risky investments. Coming up, we'll discuss how dividends can supercharge your compounding and boost your wealth even faster. Dividends are an often overlooked way to harness compounding's power. When you invest in dividend-paying stocks, not only are you earning from the stock's growth, but you're also getting paid by the company in the form of dividends. Companies like Coca-Cola and Johnson & Johnson, known for stability, reward their shareholders with regular dividend payouts. Here's how it works. Let's say you invest $10,000 in a stock with a 3% annual dividend. Instead of cashing out the $300 dividend, you reinvest it. That $300 adds to your total investment. So next year, you're earning a dividend on $10,300, not just $10,000. Over time, these reinvested dividends compound and add a substantial boost to your portfolio's value. If you hold these dividend-paying stocks in a tax-advantaged account, like an IRA, you can avoid taxes on the dividends, accelerating compounding even further. And dividends aren't just about wealth growth, they can also serve as a passive income stream. Many investors use dividend reinvestment plans, or DRIPs, to automatically reinvest dividends, creating a compounding cycle that can last a lifetime. It's a strategy that turns compounding into a reliable source of passive wealth growth, helping you wake up to the power of compounding money in a whole new way. Up next, we'll discuss inflation's impact on compounding and how to ensure your wealth grows in real terms. Inflation is a sneaky adversary that can quietly undermine the power of compounding if not accounted for. Even if your investment is compounding, inflation reduces the purchasing power of your money over time. For instance, if you're earning a 6% return on an investment, but inflation is running at 3%, your real return is only 3%. In this way, inflation is like a hidden tax on your returns, eroding the actual value of what you've earned. This is why many investors turn to assets that outpace inflation, such as stocks or real estate, rather than parking all their money in low-yield savings accounts. To truly aim for investments that yield returns well above the inflation rate. Historically, stocks have returned around 7 to 10% annually, while certain types of real estate have seen similar growth rates. These assets help you preserve and grow your purchasing power over time, keeping inflation from eating into your returns. Ignoring inflation is a common mistake, but with a bit of planning, you can make compounding work in real terms. The goal is to have your money grow faster than inflation so that your wealth increases in actual value, not just in numbers. Up next, we'll explore how to balance compounding with a solid saving strategy to stay secure at every stage. While compounding is essential for long-term wealth growth, it's crucial to balance it with a solid savings plan. Think of it as building a financial foundation. Without a stable base, your investment plans can be easily derailed by unexpected expenses. Imagine relying solely on investments and having an emergency hit. If you're forced to cash out early, you could lose future gains and even face penalties. This is where a strong savings strategy comes into play. Aim to set aside at least 20% of your income, dedicating half of that to high-growth investments and the other half to an accessible emergency fund. This dual approach allows you to benefit from the while ensuring you have a safety net for life's surprises. Remember, the goal is financial resilience. Compounding will build your wealth, but savings will protect it. By balancing both, you create a financial ecosystem that grows steadily and securely, and build a strategy that lets you sleep easy, knowing your finances are covered. Finally, let's explore the ultimate investment you can make for lifelong compounding returns: investing in yourself. One of the most powerful ways to experience compounding isn't with money at all. It's through personal growth. Skills, knowledge, and experiences create exponential returns over your lifetime. Think about it. Each time you learn something new, you're expanding your abilities and increasing your future opportunities. Warren Buffett has often said that the best investment you can make is in yourself. Every dollar spent on education, training, or even networking compounds over time. That initial investment in a new skill or course might not pay off immediately, but over time the knowledge compounds, opening doors and increasing your earning potential. In fact, research shows that people who invest in self-improvement tend to have higher incomes, greater job satisfaction, and more resilience in times of economic downturn. Imagine learning a high-demand skill like digital marketing or programming. As technology advances, your skill set grows in value, multiplying your career options and income. So, if you want to, remember that the greatest returns often come from investing in yourself. Lifelong learning and self-investment aren't just financially beneficial, they enrich every area of your life. There you have it. Compounding is a transformative concept, but only if you understand and use it well. Start small, be consistent, and let time do its magic. Today, we've explored the power of compounding from multiple angles, from financial investments to personal growth. Now it's up to you to put these principles into action. Remember, the purpose of this video is to educate you on various aspects of investing and not to give you any specific investment advice. Investing involves risks and uncertainties, and you should always do your own research and consult with qualified professionals before making any financial decisions. However, past performance does not guarantee future results, and you should always consider the risk of investments before putting your money at stake. If you find this video helpful, I recommend you watch my next video. Don't forget to like, share, and subscribe to our channel. Also, feel free to leave your comment below. I appreciate your support and see you in my next video.